Hello and welcome to the weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. Today, I want to cover just all the data that came out last week. Just to give you kind of an overview of the data, it was jam-packed. We had the initial jobless claims, we had the real GDP report, personal income, new home sales, as well as a slew of regional Fed survey data. All of them gave some very interesting information for both bulls and bears. Whether you're one or the other in the marketplace, I think you can find your biases in this data. Today, I'm just going to present it as it is and just give you kind of my overtake and my view of what I'm seeing out there to try to help you navigate the changing landscape of the economy. So with that, let's get started and let's jump into the data here. Let me start sharing my screen so that way you can just see where I'm at. What I might start with is just the GDP report. So inside of the GDP report, we had some very interesting data that I think you want to think about and call out to try to help make your determination of whether we're in a recession or not. Before we come into this, remember my viewpoint. I'm in the camp that, we are sliding and slowing back to trend, that prices are slowing down in the economy, and that may re-stimulate some demand, right? If I could just take a second and maybe just draw that out just real quickly. So if we have, GDP on like the horizontal axis, and it looks like my pen doesn't want to work, and we have prices here on the vertical axis, let's say we have some underlying level of demand here. And let's say we have some trend rate of growth. And then let's say we have some prices in the economy, and the prices just really cut. So this is the inflation rate in the economy. Now, if you have demand slowing, which is where I think we are, we've been with demand slowing for a while after they started raising interest rates. What's that going to do? Well, that's going to start to cut and slow the economy down to a new point. So maybe you slow from this, initial point all the way down here, and that creates a small recession. Well, that small recession is going to be enough to then bring prices down further. And as prices start to come down further, you get a small reacceleration in demand as people that were waiting on projects come back into the marketplace and maybe start to transact in economic activity again. That's really where I'm at. I'm at the point where maybe demand has slowed, so we can check that. We have this kind of recessionary type slowdown, and I'll show you that in the GDP data. And with the PCE price index report and with the CPI report that came out through the month of April, we also have that slowing down too. So we have all of these recipes except for maybe this reacceleration in demand. Maybe this first quarter GDP report is that. Let's take a look. So here's the real GDP report coming in at 20,235. This is in billions of dollars. So we're a $20 trillion economy here. You can see that it looks like it's growing pretty well on trend here. It looks like we're falling back to trend. Here is that actual trend rate here, 2.1% versus the 1.6%. It looks like I had already been drawing on this from using it in a prior conversation. So trend is at 2.1 versus the current at 1.6. So it is pretty clear that the economy on a year-over-year perspective is growing below trend. Now, what inside of this GDP report should we look at here? So let me grab my notes here for a second. So personal consumption was probably the bright spot of this, up 2.3%. Investments were really the dragging component, down 8.2% year over year. Inventories were also a bit of a drag. And I want to highlight each individual component today to maybe give you a better indication of what to look at. Excuse me, before we flip into the individual components of GDP, I think it makes sense to do two things. One, let's look at nominal. Let's look at the uninflation adjusted rate. But then two, let me also highlight this down here. When we look at each of the components, consumptions, investments, net exports, and government purchases, remember that consumption is almost 70% of the economy today. Now, you're seeing a box plot here because this data goes all the way back to the 1970s. I'm looking at the dispersion of the share of consumption, the dispersion of the share of investment, the dispersion of the share of government purchases. And you can see that these are basically 1, 2, and 3. So I want you to really focus on consumption, government purchases, and investments as we go through this. So let's go back up here for just a second, and let's hit on nominal first. One of the things that we have to think about and we have to square here is that nominal GDP is still very, very strong. It's very much accelerating above trend. And you've got some strategists that are saying, hey, look, this could be a situation why the Fed needs to continue to raise interest rates. That's important because they're going to be talking about raising interest rates this week. In fact, this data probably does give them the ability to raise 0.25%. And when you look at the CME FedWatch tool, they're definitely talking about raising 0.25%, roughly about 75 to 80% probability that they're going to do that, and only a small 25% chance that they're going to leave things unchanged. If they do that, that's going to raise the federal funds rate from 4.75 to 5 to 5 and 5 1/4. So you are going to get a much higher band there. And that's going to continue this chart that we put here at the top. Interest rates slow the demand side of the economy and slow the price pressure side of the economy. So this gap will get a little bit wider until we start to reaccelerate demand naturally because prices are low enough. So let's kind of keep moving through here. So we've looked at nominal GDP. Here it is versus trend. Again, it looks like I've been drawing on this already. So trend is at 7. Trend is at 6, and the current nominal GDP is at 7. So it has peaked out in 2021, in the summertime of 2021, and has been coming down for some time now, but not quite below trend just yet. So just wanted to highlight that. Here's this personal consumption. Personal consumption, again, adding 2.3% year over year. The goods consumption was the primary component that helped a lot, up 6.5% quarter over quarter. Durable goods up 16.5%. Non-durable goods was only up 0.9%. And inside of that durable goods was motor vehicle and parts. That seemed to be the largest lion's share of the increase. Service spending was also positive, up 3.5%. Healthcare and food and services, food and accommodation services, were the primary drivers of the service side of consumption here. Let's come down a little bit here, and you can see trend at 2.8% versus 2.3 year over year. So that is the consumption component. Again, looks like you've got a little bit of an increase here. I think this makes a lot of sense when you square it with the personal income report. So I'm going to flip back and forward here on you a little bit here, but personal income came in pretty strong on Friday. Let me highlight just some things that you're seeing here. Personal income at $22,717. Again, this is in billions of dollars, so that's basically almost $23 trillion. Personal income cycle, you can see that that's slightly above trend as well. Here you go. This is a nominal basis, so not inflation adjusted, 6% year over year versus 4.5%. That also has to make the case that maybe we're not in a recession, or we're in this part of the demand reaccelerating, right? This has to be some type of answer for the fact that incomes are still accelerating. Jobs, I think, are the only way that we can explain this. I hate to jump back and forth, but here's the initial claims. It came in at 230,000. So jobs seem to be okay. We fell from 240. I actually thought we would continue to accelerate. When I estimated it this last week, I put 246 compared to the 245 that came out, and it came in at 230. So again, the fact that claims kind of ticked a little bit lower, the fact that continued claims also came down, coming down from 1.86 to 1.85. I mean, I guess if you round up, you're still at 1.86. So the trend is still intact. But without more job losses, it's probably hard to actually see personal income drop significantly. Let's keep moving through here. So personal income up. Let's move down. Here's on the real adjusted perspective. So the inflation adjusted, you could see that maybe is more online with trend. But again, you can see this small acceleration here from where we fell just a few short months ago. So now that's currently at 1.7 compared to where trend is, which is minus 0.4. So even though the trend is directionally lower, the actual underlying rate is moving a little bit higher here. So where did it mostly come from? From wages and salaries. You can see that wages and salaries still extending higher here, still above trend. Here, 7.9 is the trend growth rate. Here is the actual underlying index at 7% year over year. The other thing is personal income receipts on assets. So think dividends and interest, rent payments, things of those natures. You can see a slight acceleration in dividends and a slight deceleration in interest, and yet overall the index remains higher as well. It's coming down here on the year over year, 5.8 versus the trend of 3.9. So interest from dividends and maybe interest from CDs, money market accounts, what have you, are also still trending higher. So that's feeding into the personal income report as well. So not only are wages doing okay, but so are the assets that the families are holding on to here. This leads us into disposable personal income at 19,785, again, well above trend. That also leads us into the savings rate. Again, it looks like I've been drawing on this for some others as well. This leads us into the personal savings rate. The personal savings rate you can see is reaccelerating again of 5.1%. So that seems to be doing really well there also. So let's flip back here for a second. So again, you see that consumption leading the way. Now let's move away from consumption and maybe into the investment component. So the investment component did struggle. You can see that that's well below trend. Pretty hard reduction in the investment component. And if we come down further, 2.4 is the year over year trend versus the minus 8.2. Most of this decline is still in residential investments. We know that housing starts building permits are troubled here. And yet we have seen a somewhat of a pickup, though, in sales of homes. So again, I hate to jump back and forth on you here, but let's flip over to new home sales. So we saw existing home sales come down earlier a couple weeks ago. Here's the new home sales that actually increased to 683 million. You can actually see it really well when you kind of look at this bottoming. It bottomed in September of 2022 at 550, and it's been reaccelerating all the way up to the 683. We have seen home prices come down at 449,800. We've seen inventory come down again from 463 down to 432. And then the months coming down from 10.1 down to 7.6 months of homes supplied on the market. It's interesting to see that, particularly because when we look at maybe the housing starts, building permits are highly correlated with new home sales. So you can see that with housing starts slowing down, that we've also had a slowdown in sales as well. But look at the completions. So completions continue to drive while housing sales remain slumped. I think that's interesting and important for us to call out here, because again, if investments are dragging on the economy, and these investments are primarily being hurt by the housing side of the economy, well, completions are still, showing through. It's the fact that we're not maybe selling those homes might be something to think about here. Why are we not selling these homes? Well, I would make the argument that, look, a 30-year fixed mortgage at 6.5%, this is a pretty rapid move higher. And the fact that prices are still elevated here, that combination gives you to a payment proxy of about $2,738 a month. That's very, very high where we were, call it maybe 2 years ago, where the payment was south of $1,500. So to me, that could be your primary driver there of why housing is probably going to continue to struggle. The affordability side here can continue to play a difficult part in these home buyers. Like if you're brand new coming to the marketplace, it's a difficult market to be playing in right now. If you already own a home, though, it seems like you're doing okay. So mortgage debt as a percent of income, because we've been looking at personal income here, very low. Only 4% of personal income right now is going to mortgage debt. You can see that has accelerated a little bit as the interest rate has come up, but it's not as troubling as it was in like 2008 when it was up here in the sevens. And in fact, the other thing to think about is homeowner equity. Because prices are elevated, you can see that homeowner equity is elevated. We have seen this kind of come over and come down a little bit. That's consistent with what we saw in the Case-Shiller Home Price Index. That did accelerate month over month here this week, but it did come down year over year, coming down to, I believe, 2.7%. The Case-Shiller is definitely the 20 city composite is what I use to look at. But the fact that prices are moving lower also means that home equity is probably going to move lower. So yeah, that investment component seems to continue to be troubled here. There were some positive signs in there, however. In fact, when you look at it, not only was it residential that was struggling, but structures did extremely well. Structures were up a little over 11%. Equipment was down roughly 7.3%. But again, across the board, investments were hurting overall. Let's come down. Net exports are never a real big contributor to GDP, but you can see down 1,235. They are accelerating above trend. Here's the government purchases. We know the government's been trying to tighten the belt a little bit here as the debt ceiling conversation ensues. We're at 3,482. It does look like that's slightly above trend at 2.6% versus trend at 1.3. Again, that gets us back to this component: consumption, government, and then investment. So you have a positive in consumption, you have a positive in the government, and you have pretty much two negatives here in net exports and investments. To me, it seems like, again, it's economy that's growing below trend, an economy that's, not necessarily recessionary, but definitely a situation where we are slowing. That's evident by the regional Fed survey data. If I come down here for a second, you're going to see that we got Texas coming in at minus 23.4. We also got Richmond and Kansas City. Richmond came in at minus 10. Kansas City came in at minus 21. Again, that's evident of the slowdown that's brewing in the economy. New orders for Texas, minus 9.6. Employment at 8. And then current prices paid at 19.5. This is fitting very well with kind of this diagram I'm seeing: lower demand, lower prices, right? So let's kind of take a look at the composite. Here's the composite of Texas, New York, and Philadelphia. Those are the ones that I combined together. Again, continuing to drive lower on the prices paid, index showing 20.2. Let's jump up to the employment cycle. Employment is holding. Again, that speaks to maybe why personal incomes are still somewhat elevated, while the savings rate is still doing okay. And why we've not seen mass layoffs yet, and why the initial jobless claims hasn't ticked higher. New orders, I do want to give you a small caveat here. Of all of the regional survey data that come out, New York was the only one that was positive. We talked about that at the last week. It was up almost to almost like 25, 26 points. It took it up almost 10 points for the current composite index itself. You can see the sharp acceleration here taking us to minus 2.4. But it is all New York. It's not widespread. It's only in one area. Finally, we've got the composite indicator again, still somewhat trending lower, but maybe a small increase here, minus 14.6. Again, I think this all highlights my general view of we have demand slowing down. As that demand is slowing down, that puts a gap between the trend rate of growth versus where the economy is going. That gap can be recessionary. It can be recessionary if you have another shock, right? Maybe you have a shock, because Russia goes further than Ukraine, or maybe you have a shock because the tensions with China heat up, or maybe the debt ceiling, right? The debt ceiling can definitely pose a shock if the government decides not to fund operations, if they don't pay for Social Security and Medicare and interest payments, and have to shut down national parks again. And it could be likely. I mean, we can take the personal income report and look at current tax receipts. You can see that that's coming in lower, and you can see that that's the lowest reading that we've seen lower than COVID, lower than '08, and even lower than the 2000 period. So, if the current taxes coming in are lower, that means the government still has less money to operate on. And again, I think that can pose a problem for funding the government and also for the U.S. Treasury, and why, yeah, they are getting tax receipts now, but they may have to push those out, right? And so maybe it's not a June deadline, but maybe it's like a July or August deadline to get the government funded here. What else do I have for you? So again, you've got an economy that's slowing. You've got prices coming down. You've got a good unemployment rate. If I were Fed chair moving into Fed week, I wouldn't do anything. I would leave interest rates right where they are. You've kind of got this happy medium going, or Goldilocks, or however you want to term it. More interest rate hikes could be warranted, right? I mean, the fact that, the PCE price index did come out and you saw the core number drop from 4.7 down to 4.6, but you saw the headline come down from 5.1 to 4.2. So there's still progress being made to your 2%. But then you can also give credibility to the banking crisis. That's another shock that we can't ignore. First Republic seems to be failing. They were down again on Friday. I'm surprised we haven't heard some news here over the weekend that they're going into FDIC receivership, or that there's going to be some bailout. But still, that's another shock that we have to account for. And I think if you hold rates, if you leave rates where they are, you give credibility to the banking crisis and saying that you acknowledge it and you understand that your policies are restrictive. But then you also say, look, we still have to remain high, so that way we continue the downward pressure on prices that we've already experienced. Again, this is important for us to think about as we're, trying to allocate dollars in the market, or trying to operate our businesses, or what have you. But to me, the market's built in a 25% increase as far as the probability of that from the CME tool. They will probably do 25, but they'll probably give strong language around not only pausing, but remaining restrictive. I think that's important at this point. Again, I think you understand my framework, you understand my viewpoint. I do think that there could be a reacceleration in the economy as long as there's not another shock. I don't think we're in recession right now, as evident by this Q1 GDP report. I will say that your leading indicators are troubling. The LEI from the Conference Board was troubling. These regional survey data are troubling. And we're going to get the PMI report tomorrow, and the PMI report tomorrow could also be troubling. So, if those continue to point lower, then, you do have an economy that's going to continue to slow, and it's going to make it vulnerable to these shocks. And that's why I want to continue to highlight that. I do think you have to have a shock here at this point to tip the economy in recession. You don't have the unemployment rate rising fast enough just yet. You have personal income picking back up again. And so these are things that I'm kind of trying to square and trying to build off of. Finally, before we go here, the only other piece of data that we got was the bank assets and liabilities. I spent a lot of time on that last time. Here, I won't spend as much time. What I will say is bank deposits increased $21 billion compared to where they declined. You could probably barely see it in the chart here. I mean, the way that I have it probably doesn't. You probably see it a little bit more in that small. Let me come down here. Yeah, you can see it a little better there, reaccelerating. You can see it a little better there in the small banks. Not so much in the large banks, though. So the small banks picking up a little bit of market share in the last weekly data. I'll continue to update these so you can see them. I might even shrinken it so we can maybe, instead of looking all the way back to the 90s, maybe shrink it to maybe the last 10 years or something, so we can see the moves a little bit better on these charts. I think that's all I have for you. Don't forget that it's also the employment week coming up. So you're going to get the unemployment rate, you're going to get the labor force participation rate, you're going to get the non-farm payrolls report. Those are all going to be important too. We did hear more layoffs. Disney kind of comes to mind as I'm kind of off the cuff here. Disney was talking about laying off an additional 7,000 workers here. So we should see some more continued softening in the non-farm payrolls. That's going to continue to echo what we're seeing in the regional Fed survey data. So let's flip back over here for just a second. Let's go down to the employment side. That has been coming down now for some time. So that is indicative of some softening in the labor market. And then also the Kansas City labor market index, which compiles 24 composite indicators together, that's also been slowing now since the summer of 2021 as well. So again, watch the employment report, watch the Fed meeting this week, watch the PMI reports. All of those are going to continue to add to what we already know is an economy that's slowing and growing below trend, and that's vulnerable to a recession if you have another shock. I think that's the best way to describe the situation we're in. I think it's probably the best unbiased way to describe it as well. I do think you need another shock here before we can sound the recession bells here. With that, I've ran long enough. Feel free to leave a comment below or shoot me an email if you have any questions on what I'm looking at, or if you'd like me to dive into something here. Feel free to reach out to us. Be happy to answer those questions for you. We'll be back next week with another weekly update. I hope you guys have a great week, and we'll talk soon.